Take a breath. After a wild climb in gold and silver prices and even wilder headlines screaming about a silver squeeze, the markets are finally taking a break. A couple of weeks ago, we questioned whether what we were seeing was a genuine squeeze or just hype. And today we're going to dig deeper into that. Because what happens next, as always, depends on what's already come before. If you value precious metal news without the hype, please consider subscribing. Your support makes a big difference. Thank you. Some say the silver squeeze is over. We've been asking a different question. Was there ever one at all? The data and price action never pointed to a squeeze, they pointed to a shortage. And as time passes, it's becoming harder to deny that the so-called squeeze may have been more branding than reality. Let's clear up how short squeezes actually happen by looking at a recent example. The most famous, of course, is GameStop, the Reddit-fueled frenzy from a few years ago. In that case, institutions were naked shorting the stock, selling shares they didn't actually own, betting they could buy them back later at a lower price to return to the lender. Here's a simple explanation. Imagine you borrow your friend's baseball card, sell it for $100, and plan to buy it back later when you think the price will drop to $50. If you're right, you keep the $50 difference as profit. That's what short selling is, betting that something will lose value. But if the price goes up instead of down, say that card jumps to $150, you still owe your friend their card back. Now you have to buy it at the higher price to return it. The more people in your situation, the more everyone scrambles to buy at once, pushing the price even higher. That's the squeeze. With GameStop, big investors had borrowed and sold more shares than even existed, called naked shorting. When the Reddit crowd started buying and holding shares, it trapped the short sellers. The only way for them to close their positions was to buy those same shares back, and since few people were selling, prices skyrocketed. A silver squeeze would, in theory, play out much the same way. If enough traders were short silver, betting against the price, and investors coordinated to buy and hold the physical metal, that demand could force short sellers to cover, sending prices sharply higher. The problem is that silver isn't a niche stock. It's a massive global market, and it's constantly being replenished through mining and recycling. That makes it far harder to corner, let alone squeeze. On paper, the silver market might look a bit like GameStop. The silver-to-paper ratio is often cited anywhere between 250 to 1 and 400 to 1, depending on who's counting and when. In simple terms, that means hundreds of ounces of silver are traded for every actual ounce of metal that exists. At first glance, that sounds catastrophic, the kind of imbalance that could trigger a collapse straight out of ancient history. If only it were that simple. Some of those paper positions belong to speculators taking risky short bets, but others are simply hedges against physical inventory or part of a legitimate chain of custody. The ratio makes for a great headline, but it doesn't tell the whole story. The key to any squeeze is that short sellers are forced to buy back in while physical holders refuse to sell until prices reach ridiculous premiums. That creates the upward spiral. But we didn't see that happen. What we actually saw were clear signs of stress, not a squeeze. Silver was in short supply, lease rates shot above 30%, and manufacturers were scrambling to buy small quantities for same-day delivery just to keep production running. Refineries were already maxed out, gold and silver prices were moving together, sometimes gold even leading the charge, and mints were throttled by timing issues and sky-high lease rates. Last month, more than 29 million ounces of silver were shipped from the US to London. Within days of that news breaking, premiums for same-day physical delivery began to fall as inventory flowed to the markets that needed it most, and lease rates dropped back below 5% by the end of October. That's normal arbitrage, institutions moving metal out of US storage and into the market to capture profitable premiums. What we witnessed wasn't a squeeze at all. It was a classic supply shock, and that's actually good news for anyone holding metal. A squeeze burns out fast, like a flash in the pan. A shortage, on the other hand, can provide sustained strength in prices, and the evidence further supports this theory. Even after lease rates eased, spreads tightened, the Fed cast doubt on a December rate cut, and headlines declared the silver squeeze over, silver prices still jumped nearly 3% in a single day. The influx of metal into the market had an impact, but it didn't fix the imbalance. The market remains in backwardation. Spot prices are still higher than futures, a clear sign that supply is tight and demand hasn't gone anywhere. The London market is still short on available silver, while much of the metal it needs remains in the US, a deliberate buffer against any trade policies that might tax the metal. With silver now proposed for inclusion on the critical minerals list, that concern isn't unfounded. If it makes the final list, it could open the door to tighter regulations and fewer overseas shipments. Institutions here aren't taking chances. The official list is expected November 9th, though that timeline could slip due to the government shutdown. Either way, without a strong profit incentive, the 500 million ounces still in US vaults are unlikely to move anytime soon. If silver doesn't make the final cut, some of that supply could start moving overseas, but it won't happen overnight. Shipments travel by boat, and that takes time. Air freight would only happen if premiums were rich enough to justify it. In a normal market, when metal moves overseas, sellers are chasing pennies on the dollar. But silver is heavy, and weight limits make air transport expensive. Gold often flies, because the premiums are higher and the value is concentrated in far fewer ounces. With silver, the math rarely works. Only when things get truly tight do we see premiums large enough to cover the cost of flying metal from one continent to another. And that delay matters. It prolongs shortages. It's simple logistics, but in a world used to instant digital access and free 2-day delivery, it's easy to forget that silver doesn't travel at the speed of convenience. So right now, the market is short on physical silver, with much of the available supply still sitting in the US. If trade policy becomes clearer, some of that metal could start moving overseas and ease the shortage, but that process will take time. First, the risk has to truly subside, and then the metal has to physically make the trip, which takes weeks on its own. In the meantime, prices are likely to stay elevated. Not a squeeze, a shortage, and one that isn't going away anytime soon. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.